So, Mr. Angelo, the floor is yours, my friend.
Yeah, well, thank you so much for having me today, Jamila. It's awesome. I always love working with you and always admired you. So I'm really honored to talk to your team. So yeah, the reason why I wanted to talk to you guys, we're in the lending side. And what's interesting about us is that we are actually somewhat unique because we're not like a traditional lender that just does, residential mortgages. We have two different sectors to our company. We have a banking division, and then we have a private equity group as well. And it makes us very dynamic in the sense that we can fund anything from, the billionaire that's, we have deals that are $200-300 million loans, $50 million loans for multifamily master plan developments, to the first time buyer, FHA or VA that doesn't have the best of credit. And so we do everything from hard money, private loans to investor lines of credit. And really right now, to give inspiration to you guys out there in the street trying to close deals, you're trying to find out what products are working, what's not working because of COVID, and trying to stay optimistic, right? So really want to see where you guys are at, what hangups you're having, and what products you have questions about to see what's working, what's not working right now in the market.
I forgot to mention this is an open session, so yeah. A lot of you guys are having some challenges with clients or this, that, and the other. So throw your questions out at Angelo. That's what he's here for. If y'all are working with investors as well, throw those questions up. If you're working with commercial, throw the hands up. Brandy, I saw your hand go up.
Yeah, hey, Brandy.
Hey, so I just ran into this. I had a client that was approved, qualified for FHA, and they sold their house, and we kind of waited for a minute, and then we went to go and we found the house of their dreams, and we went to put the offer on, and they no longer qualified because they had changed the requirements for FHA, and so their credit score landed like right at 560, and it was their DTI was like 3 points or 10 points or something below the new requirement. And so I kind of lost like an FHA pool of buyers.
Yeah.
And so nobody was willing to take a risk on them. Are you guys taking higher risk FHA buyers?
So it's a good question. So we are a Ginnie Mae lender, and what that means is that we can go down to a 580 credit score for FHA. There has been a lot of changes with government lending. One of the biggest things is that from this whole liquidity crisis, the government hasn't really bailed out servicers. And so what's happened is that from these payment redemptions, from people not making their payments on government loans, the servicers are having to make the additional payment for the customer that actually isn't making their mortgage payments right now. So as a result, they've raised the credit score requirements for most of the lenders out there. So you're seeing people 680 credit score for an FHA loan. We're still at going down to a 580 credit score for FHA. If it's sub 580, they have to put 10% down for FHA. And one of the unique things about us is that we actually do free credit boosting for our clients. A lot of times we have a credit attorney on site. And so we help a lot of our clients to boost up their credit score for free. Let's say that they're at a 583 and we can get them to a 620. That can get them, 1% lower interest rate and better terms on their loan, then we do that for them, right? So it just depends on the situation and, the overall dynamics of the loan. But one other thing is that when you are at a 580 credit score, like you mentioned, the debt ratio, you're usually capped at around a 43% debt ratio versus if you can get them to a 620, then you can go up to like a 50 or 55%. So we'd have to take a look at the file, but the fact that if the customer has, the 3.5% down, and their credit's marginal, we can that's our ideal client that we can help them to still get them funding. And what we're starting to see is that they're starting to loosen up a little bit, and so I would say probably in June, from what we're seeing from the secondary market, is when that credit threshold should lighten up. But that would be our solution.
Another thing that came up was a buyer asking about getting approval and then requesting a forbearance. And from what I understand, or what the lender had said to me, that the risk to the lender is that if they go straight into forbearance, then like what you were saying a minute ago, that lender now has to pay.
That's right. That's right.
So what kind of, I mean, you know, when you're trying to sell a house and there's this opportunity for this buyer to buy time on having to start their mortgage payment. I mean, I'm not a lender.
Yeah, it's a good question. So some of the things that we offer, we offer a few incentives with some of our programs. One of the biggest things, like I said, is the free credit repair. But the other thing is that we can do automatically built in up to 2 months, no house payments. So let's say that we close in June, they wouldn't have to make a house payment, until August. But they're actually going to have to execute an addendum at closing that they're not going to file for forbearance, or we won't be able to fund the loan. So, but we're going to give them 2 months built in with interest reserve, so that way they don't have to make their payment for 2 months. But we can't, because that puts us at a huge risk. And it's not just that one client. When it's 10,000 loans, that's $100 million check that someone has to write for people not making their payment. So that's when the servicers start to get really concerned. So at closing, what we have to do right now is actually have them execute that addendum, and so it's just part to protect us as the lender, and so, yeah, I mean, but as a compensating factor, solution is to build in, 2 months, so it helps the client. Like I said, a lot of the things that, going back to the credit repair piece, I don't know if you guys deal with customers that have lower FICO scores. A lot of times they're paying credit repair companies to fix their credit. They're paying $100 a month, $200 a month. That's something that we actually do for free for our clients. So it's very powerful. It's very compelling. Hey, you know what? We'll also help you to fix your credit in the meantime, because a lot of times you have customers, maybe they don't qualify right now and they're not ready. And it's not good to let that customer go, because the whole part of this business is capturing a client. So we put them in our retention pool and we start working on their credit to build them up. And in 1 or 2 months, they're going to be ready. So if you're planning on being in this, industry for the next, year or two, in your long-term perspective, it's very good to incubate those customers and fix their credit, so that way they can qualify for a loan later, right? So.
All right, well, let me just ask another random question.
Please, yeah.
So Robert just had a deal, and I'd never heard of this or seen it before, but he had a client that qualified for a 0 down payment conventional loan. Are those being offered? Like, how is that possible?
So it depends on what the customer qualifies for, as far as with their credit and their income. There are some programs through Seth and T-Shack where you can do either a government or a conventional 0 down loan. Typically what happens, though, there's income restrictions. You have to usually make below the median income for the census, which is under 80K. And the debt ratio is usually capped at 41%. So, and the other thing is that it's usually a bond program where the interest rate is going to be slightly higher. It is still available. And, basically you just have to see if the customer is eligible for it. The ideal customer is someone that has a low debt ratio. Their income is, usually sub 80K, and, they are a first time buyer, and it is possible to do on a conventional side too. The downside to that program is that the interest rate is usually, because it's through a state bond, that the interest rate is somewhat higher. So for example, if someone put 3% down on a mortgage on a conventional loan, they could get, let's just say, a 3.3 interest rate. But if they go through a state bond program, the interest rate could be 1% higher. Ultimately, in the end, it's the customer's discretion on what they want to do. We would give them both options, right? But it is possible, yeah. So,
Angelo, the program where they do the 2 months free, is that a traditional product, or that's something that you guys are?
No, it's just for any loan, FHA, VA, conventional, USDA, jumbo. So the thing is that we're just doing that as a incentive to induce people to, you're starting to see car dealers do that, right? Right.
Okay, got it.
It's just something that another program that we have that's very strong because we are a bank is we have a jumbo program with just 5% down. I don't know if does anyone do jumbo here? Larger clients?
I think we have some that do.
Yeah.
Do some jumbo. Let me see. Nettie's done some jumbo. I think there are just a handful of people in here.
Well, I do want to talk on that because it is a very unique product. So you can, a lot of times with jumbo, you have to put 10 to 20% down. With our jumbo program, you can just do 5% down. And what's cool about it is you can actually, Rob has a customer right now, and Rob's on this message. He's actually my chief lending officer. And he actually has a client right now that's doing a jumbo mortgage, and they also get a line of credit embedded with the loan. So it's a first and a second with no PMI. So there's no PMI. The second loan, in this example, he's buying a home in spring for $700,000. He's getting a credit line for $164,000.
Wow.
So it's a revolving credit line that you can use anytime, and the customer is self-employed. So he really likes that option because when he pays that down, he can charge it right back up for his business. In the event of something happen in the future, he needs a credit line.
So how is he qualifying? Is it bank statements? Is it?
It's a full doc loan.
Oh, okay.
It's a full doc loan, but it's cool because he can buy a $700,000 home, and he just has to put 5% down, and he's getting his first mortgage's interest rate's like 3.3.
Wow.
So a very good deal. Whereas a lot of lenders right now aren't doing jumbo mortgages. So that's a very attractive program. But the whole idea is I do want to let you guys know that we still have a lot of great programs out there. Does anyone do commercial loans here?
I was about to ask you a question, Angelo. Do you guys offer a 30% and a 70% loan, like for lenders that will lend 70% and then the client goes and gets another 30% loan as well?
On a primary or what type of property?
On a commercial deal.
So us as the first lien holder will do a 70, and then we'll allow a second to do a 30.
Correct.
It depends on so what type of commercial property is it?
Multifamily, retail centers, flea markets.
That's an interesting one. I've never heard that before.
So here's what we do have. I'm glad you brought that up because mainly what I deal with is commercial loans, and I deal with that's really what I specialize in, a lot of commercial lending. So on the commercial loans, we do hard money, and we have a private money, and then we have a banking line, and we do a lot of agency loans. Like right before I came on this call, I was doing a Fannie Mae loan for a client in Boca Raton. It's a $70 million multifamily that we just LOI'd. So, but to answer your question, the way that if someone was getting 100% financing on commercial, that's going to have to be, there's a few different ways how we could structure that. We use transactional funding. And if we try to do this deal where the terms are going to be sensible to the client, like, low interest rates, we would use a transactional funder to get down payment assistance to cover that 30%. And you can still, basically, in other words, let me give you an example. Let's say the property is for $5 million, but it's really worth $7 million. Okay. So we would raise the price to the 7 and then use the embedded equity of the $2 million to cover the down payment, essentially rolling the down payment into the loan. All right. And then you could still get a banking loan, and we'd be able to provide a proof of funds letter from the transactional funder in the borrower's name. So that's a strategy that you could use for getting still a bank loan. But if you don't want to do that, the seller's carrying the second, like 30%, then that's going to have to be more. If it's 100% CLTV, then that's going to have to be more of a hard money loan, which can be done, but the terms are going to be, the interest is going to be double digits, and it's going to be a short-term bridge loan, usually a 1-year note. Interest is going to be 10 to 12%, right? So, and then we'd have to refi you out to a perm loan. So it just depends. These loans, they get very, very specific, and I have to see the deal, but it depends on how we structure it and the property. Another thing that's very powerful, if you guys do commercial loans or non-owner occupied, we have a really strong product called a reverse purchase. And it works really, really well if you guys do commercial deals. Let me give you an example of how it works. You mentioned, some of the different type of properties that you're doing with commercial. We have a client that just bought a washateria in Virginia with no money down. And it's called a reverse purchase, where the client basically, he wanted to buy this washateria for $1 million. The seller's motivated. They want to get out of the deal. So he contacts us. And the way it works is we essentially put the client on title today. And the seller agrees to stay on title and allow the borrower to go on title with them. And it's a short-term bridge loan. It's a 2-year note. And they get up to 50% loan to value on a first mortgage with us. And then the seller carries a second mortgage for the other 50%. So the buyer is able to purchase the property with no money down, get 100% financing, and the seller still stays on title with the borrower. Okay, so he bought this washateria for no money down, got 100% financing, and then what he's going to do is rehab it, and then we're going to refi him out, take out the seller in a year, and then give him a permanent mortgage. So it's a very good strategy. If you have sellers that are motivated to get out of their property, especially right now with commercial, because a lot of commercial loans are dead. A lot of the Houston local commercial lenders, they're not even returning calls right now. Go try to get someone from Allegiance to call you back on a commercial deal. They're not lending. And so if you are doing commercial and you're having, I was dealing with a commercial deal the other day. Sellers are very motivated right now, so private money balance sheet loans are still very strong, and those investors are there lined up to make these loans. We did one multifamily in the Galleria near the St. Regis for a client, the very exact same thing. Motivated seller wanted to get out. It's worth $3 million. Put the borrower on title, did a refinance. He got cash out, fixed it up, and then turned it into a senior living facility. So it really, really depends on the situation. But yes, we've done a lot of 100% financing on commercial.
Perfect.
There are a couple of questions real quick. So Melinda wants to know, do you have SEF money?
Yes, we do. So SEF, S-E-T-H.
Mm-hmm. Yeah,
so we do SEF, TDHCA, and this is subject to those requirements. But right now, I think SEF is they did change, Melinda, they did change their requirements recently. They're at a 680 credit score or higher. They were lower, and as you may know, they were down to 620 prior to COVID, but now we do SEF. We also do Chenoa. You may have heard of Chenoa Fund. SEF and TSHAC has better pricing, and I recommend that over Chenoa. But we do offer those programs, and they're, it's just subject to approval. And they do have a conventional program. I know, Brandy, you're asking about that earlier. They do have a conventional program as well. So.
And then Shannon wants to know, she has two questions. What documentation is required for a commercial loan that you just mentioned? And for a deal like with the motivated seller, what would you need from the buyer? Well,
so that's a great question. So if you're doing a hard money loan, it's asset based, right? These loans that we're just referring to, like a reverse purchase or where the seller is doing a carry, those are asset based loans. So really it's a short term loan, and on those loan programs, it's not based about the customer's financials or their credit. So typically they're going to fill out an application, and then there's no rent roll, there's no financials, none of that's required. What's more important is the appraisal. So we do have to get an appraisal on the property, and what it appraises for is very important. So generally, it's an MAI appraisal if it's a commercial property, and these asset-based loans, we're going to be lending up to about 50% of the value of the property. And then the seller is going to come behind and then carry a second mortgage. So on one of your TREC addendums is a seller financing addendum. the seller is going to have to execute that. And they're going to be creating a second mortgage, and the terms are going to have to be negotiated with the borrower and the seller. And so typically it's a loan application. We have to order the appraisal. We still go through title. We can go through your preferred title. And then the seller financing addendum. And then we need to have an exit strategy from the borrower. What is the borrower's exit strategy? Is he going to flip it? Is he going to rehab it? We need to convert it to a perm loan. If he's going to convert it to a perm loan, we have to structure him out for a year or two to be ready to be in position with rent rolls, with financials for a bank perm loan. So it just depends on, what the customer's intentions are, and if they need rehab money. Like Rob and I are doing a hotel for a guy in Tennessee. I think, Rob, how much is that hotel worth? Like $5 million? Rob, you still on here?
I think he's
on. Yeah, it's just a peak over $5 million.
Yeah, and how
We're
much?
Doing 2 for him.
Yeah, but how much is he? That's a great example. Let's talk on that hotel, because if you guys ever do hotels, that's a very good deal for inspiration for everybody.
I have an agent that does a ton of hotels, so that's actually not a bad deal.
Especially
right now. I didn't hear this, and I may have missed it. Credit requirements for a borrower like this. Is it just based on the property, or you're not even?
There's no credit requirements. There's no income check.
Okay.
So
it's based on the deal, essentially.
It's based on the asset. So so one of the things that we work with. So one of the things about us being a private equity company, we work with insurance companies, REITs, family offices. A wealthy, like the investor I was mentioning earlier in Boca, they buy our notes from us. And so a family office that I have a very good relationship in New York, they buy a lot of our loans. So they're not hurting right now. The institutions are hurting. Mm-hmm. So they'll make a decision, discretionary capital, to be able to fund that deal for us. So we're still able to make these loans. And so Rob has this, if you guys, you mentioned your agent that does hotel deals. Right now, the hotel market is essentially dead. We do SBA loans. Mm. We have SBA loans that are live right now online for hotels and hard money. But this deal that Rob, I want you to kind of talk about that, because I don't know any lender on the planet that would do a deal like this. So
no, this is definitely very creative, but it makes sense. It's strategic, right? So, lastly, I think we're coming up.
He's trying to get Rob to tell the story. You keep interrupting.
My husband just chastised me, y'all. I'm so sorry. Rob, go ahead.
That's fine. Yeah, actually, so we're working with him today to get him finalized for the end of this month. But it's a hotel that was actually vacant, and the seller, still owns. So we are we'll be doing a 50% first and a 50%. The seller will be holding back a 50% second. But we're fronting the money for him to be able to rehab, open up the hotel back up, and then within a year be looking to do a permanent takeout. And with these, we've been using the SBA. SBA is a great product for hotels. We have a lot of lenders that we work with that still love the hospitality industry, and we use that takeout with the 7A. So he actually went to 25 banks and got no's. And due to Angelo's, I call it your program, Angelo. But because of this program, we were actually be able to be his yes. So we're the last lender he talked to, and we're looking to close him this month.
Awesome.
Yeah, it's really powerful. The relationships, and you have a network, a pool of capital to be able to, help anybody whether it's a land deal. We do a lot of ground up construction with FHA. So if any of your clients, you do multifamily ground up construction, we have a ton of those deals working right now. So we will have lines of credit coming back online in June. So investor lines of credit. If any of you guys work with investors, we have a credit line up to $100 million that we can give to an investor for fix and flip, ground up construction, multifamily, and mixed use. That's a very, very powerful credit line with up to 90% LTV leverage. So a huge product.
A couple more questions in the chat room. Houston wants to know, do you have loans that allow for buy-ins, and do you have venture capital investors?
We do. So on the loans for buying, you mean like if you want to invest in buying a note? Is that what you're referring to?
I have a specific client that if I sell one deal, the seller of this deal will buy in $1 million for the next deal. and basically he wants to be a part of that business.
So, like, give me an example. I want to make sure I understand what you're saying. So, when you say that, I just want to make sure I understand what you're asking me. So,
basically, the deal hasn't closed yet. So, can the buyer for the bigger deal use the contingency buy-in to help him qualify for the larger deal?
is he investing into that project?
Yes.
Okay. How much is he? So he's going to be an equity investor in it?
Yeah, correct. He's going to invest $1 million and manage the place, but the property is selling for $6 million.
Okay. And then do they have a like a partnership agreement?
Once one deal is closed, they'll work that out. They don't have anything right now.
Okay.
Everybody's in agreement, so they just don't have a deal worked out.
Of course, it can be done. I guess the thing is that who's going to be the signer on the loan, or do they want non-recourse?
That's a good question.
Yeah, because the thing is that we need to find out. So if he wants to do a non-recourse loan, if he has more than 25% equity in the company or the corporation, then we'd have to see his financials. Yes, it can be done, but I would need to know more information on, the type of loan they want and how they want to structure it. But yeah, you can inject equity from a third party, whether it's a non-interest or if it's a shareholder in the company. But we'd have to see, a little bit more about their operating agreement or their how they're structured, their organizational structure. But of course, you can definitely do that. Then, as far as venture capital, when you say do we work with venture capital?
All right. So, do you have venture capitalists that will invest in, for example, dentists or optometrists? These different doctors are looking to open up practices, but they need the funding, for equipment for of a building.
Okay, that's a good question. That's an SBA type situation. It sounds like, right, Rob?
Yeah, we do. We do a lot of equipment financing, and actually, I've financed multiple doctors, veterinarians here in Houston, utilizing SBA just for the equipment loan itself.
Okay.
Yeah, so
something that you guys can kind of. I would say Houston, definitely set up some time with Angelo to go over those.
Yeah, SBA is very powerful, guys. There's two different types of SBA loans. There's a 7A and a 504, one for real estate and one for like working capital or franchises and stuff like that. So SBA is still funding. It's very hot. So if you're in situations for owner occupied, that is a very powerful loan right now.
Last question in the room. Do you do church builds and funeral builds?
Yeah. So for ground up construction?
Mm-hmm.
Absolutely, yeah. So we can do church, we can do funeral. We can do pretty much anything depending on what the customer wants. We can go up to usually 75% loan to value. We can do non-recourse. It just depends on the size of the deal, the sponsor. Generally ground up construction, especially right now, the deals that they want to see is usually 5 million plus. But yeah, it can be an agency. So a lot of people don't know that FHA actually does multifamily ground up construction. And we do a lot of that for senior living, student housing, mobile home parks. So it just depends. And with FHA, it's actually up to 85% LTV. And that's also non-recourse. So it just depends on the client and how they want to do it. Sometimes, like you mentioned, you have a partner that's, maybe doesn't want to be a signer on the loan. So we'd have to do a non-recourse type situation, which means that the borrower, the signers they're not a personal guarantor on the loan. If the deal falls apart, they can't come after their assets personally. So we do a lot of non-recourse loans. So, it just depends on the deal. And obviously, with real estate and lending, a lot of this stuff gets very, very specific. And we have to kind of really drill down and see, what the client situation is so we can figure out how to structure the loan.
Gotcha. And there was one question from Nikki about you doing hard money. I think I already answered that, Nikki. Yeah, they do a ton of hard money.
Yeah, we do a lot of hard money. I mean, we got a ton of stuff in Houston going on right now with hard money loans, and whether it's fix and flip or it's short term like Airbnb, bridge to perm. It just depends on, the type of deal. With hard money in Houston, we can still get up to about 65, 70%. A lot of lenders right now are shying away because of everything with the oil prices and all that, but we're still doing up to 65, 70% LTV. We can do raw land too. So if someone wants to cash out against raw land, the LTVs are a little bit lower, but really it just depends on what you have. I mean, today the biggest thing I want to instill confidence in you guys that if you're having a hard time getting funding, give us a shot. What do you have to lose? You might learn a few things. I might learn a few things about you. And that's how, in fact, Jamila, that's how her and I have kind of crossed paths. She couldn't get deals funded from other lenders. And she texts me, hey man, can you help me here with this? And I think my batting average is pretty good with you, right?
Listen, you made me a believer. It was an impossible loan. This was a loan. This was a foreign national buying a home. They didn't have no rental, no income, but she had money, no social security. It was a mess of a loan. She had been through 4 lenders and she was on the buyer side. So she was going to terminate the contract. So I had to get her on the phone, get my seller on the phone, and just try to get this whole thing negotiated. So, hey, let's just give this thing one more chance. And Angela knocked it out of the park. I felt like it was impossible. I knew we were going to lose that deal, but it was amazing. So no, you are definitely one for the books there for sure. I have a lot of faith in what you do, and you're real with it too. So you'll let me know if you can get something done.
Right. That's the main thing. Yeah. We really try to go the extra mile to try and figure it out. A lot of times, deals fall apart because the person isn't experienced or they don't want to put forth the effort and the structure. And it all comes down to the structuring. Rob's been in the industry for over 30 years and a master at structuring. And you really, really have to understand the guidelines on how to put a deal together.
Yeah. So we're a little past time. I know there are a few more questions in the room. I'll probably just send those to you, and you can just kind of answer it on our Facebook page or something like that. One of them, I guess, you don't have to go into it in detail, but just kind of keep this in mind. A couple of questions that came on was, do you do loans and lot loans, and what's the minimum amount? And then I think Garrett, he's already answered that question about FHA. I believe you guys. He says, how's the company able to approve at 589 when so many have raised a minimum to the higher 600s, 580s?
What was that?
The first question was, do you do lot loans, and what's the minimum amount?
Okay. Yeah. So lot loans, it depends on if they're. So here's the thing: if someone's just looking to purchase raw land and not do anything with it, that's a huge difference versus if somebody's looking to do like ground up construction. So raw land, like, hey, I just want to buy this land and hold on to it. That's 50% LTV, right now. Usually it's 65, 75% LTV. Right now, raw land with no intended use is 50% LTV. If they're going to build something on there, then you could go up to 75, 85% LTV. Let's say they want to build, like a daycare, right? Or they want to build a, something for their practice, or an attorney or a doctor. They want to build a building. It's better to get them to do that than that way they can get max leverage, right? So it just depends on the situation. And then on the FHA, what did he say about 589?
How can you guys do 589 when everybody's kind of up?
Well, because when you lend to Ginnie Mae, when they're a Ginnie Mae servicer, they put it on the lender to make the discretion on what credit score they're going to make. It's the lender that has an overlay based on what they want to do. So let's say that, FHA doesn't have a credit score requirement, right? If you read their 45, 55, you could make a loan at 500. Carrington is still doing loans at 500.
Mm-hmm. That's true.
Yeah. So it's up to the lender to make the decision if they want to take on that risk or not. And we're still lending out to that credit score, and that will go in our Ginnie Mae pool. So, but like I said, you have to understand that, and this is what I said in the beginning of the call, Because if someone has a 580 credit score and you have the potential, the opportunity to take them to 620 or 640, you're far better off doing that because everything changes with the underwriting, the interest rate, the cost of the loan. So it really, really depends. I mean, I've closed clients that were at a 580. We didn't have the time to get them to a 620. Okay, fine. Close them at a 580. This is a situation, but if you can get them to a 620 and it only takes a week that we do a rescore on the person to boost their credit up, that's a way better deal for the client.
All right, so that's we got a few more questions, and I'll send those questions to you. But we're coming up on time. I want to definitely give Brandy and Kirby a chance to speak. Angelo, this has been awesome. Now, I'm probably going to bring you back because another thing I wanted to talk about was the investment side. One of the things that we have in our office, outside of the, building legacy and making sure our agents are enterprising and they're also investing in themselves and their future. I know that you have an investment side where you teach agents how to purchase investment property, multifamily, and all that good stuff. So I'd love to bring you back for that. Our agents can purchase up to 4 homes a year without having to pay, fees and things like that.
Oh,
so
wow.
I think it's an amazing thing for them to use that to invest in themselves as well. So, I'll bring you back for that one of our segments, even if it's just a Facebook Live. But I really appreciate you and Rob coming on and talking to us. And some good information. You actually have my wheels turned. So I'm going to be calling you about some deals.
Yeah, love it.
Right now. So, but yeah, definitely. Thank you. And feel free to stay on. You don't have to leave. I think we're 20 minutes in to our time, but I'm going to start with Kirby because I want to finish out with Brandy. Kirby, if you want to take a chance to just introduce yourself. I don't know why you look like you are in a hole somewhere. Are you been held captive? Are you okay?
I'm all good. I got the lights off. I got a studio light going on. I had some dramatic effect. That's all.
No, it's all good. It's all good. So if you'll take some time to introduce yourself. So Kirby is our new director of digital strategy, and he's one of the brains behind a lot of the Facebook ads for lead generations and an online lead gen. And he's just a whiz at what he does. And we're so glad that he's accepted the call to just come join us as an exclusive consultant. So what Kirby is going to be offering in our office is not going to be offered anywhere else. So again, Kirby, just introduce yourself. You don't have to go through everything in detail. We're going to have a live Q&A with you later on. But I just want everybody to get to know you a little bit.
Yeah, sure. I am Kirby Weber. I'm from Des Moines, Iowa. I'm not in Houston. For those who don't know, Des Moines, Iowa is like the Midwest of the Midwest. You can't get any more center of the Midwest than Des Moines, Iowa. Not to be mixed with Idaho or Ohio. That gets confused a lot. I know. So I have a digital marketing agency that goes by the name of Digital Revolt. Of course, we specialize with brokers, teams, agents, and on the mortgage side as well. I got a couple of clients and obviously been doing a lot of deals and communicating with Jamila and Pat. Really, I'm just an open book. I don't really want to take up a whole lot of time, but what I am going to say really quickly is that 1, we are going to have a Q&A coming up. 2, I have a couple of classes I'm already working on that we will be getting into within a couple of weeks. A couple of master classes. I'll make myself available if you want to reach out to me and if you have any kind of questions. And that's really all that I have for now. I just want to give Brandy some time because I'm here, so I don't need to.
For those of you that are doing online lead gen, everybody knows you use Zillow, you use Google, whatever. A lot of those leads and that data does not belong to you. So last year we had the Mega Agent Bootcamp where we had the Zillow Killer, which Kirby is a part of that nation. And so I prefer being able to own my own data and own my own leads. And that's the reason why we generate Facebook leads versus going to Zillow. With Kirby, we're able to generate anywhere from 60 to 100 leads per campaign. And so, but those are leads that basically fill our pipeline up, and he can work both on the mortgage side and on the real estate side as well. But the team that we have, TWG, they're still working those leads. Jennifer, I'll use Jennifer as an example because I know that she's like, I call her the lead monster. She will not let you go. You get a lead in her hand, she's going to hold on to it. You're either going to die out or you're going to tell her to jump off a lake. And she's still closing those deals, even a year and a half later. So Kirby's going to help a lot with that, just kind of help putting that plan together. And if you basically want to start doing those things at a high level, that's what he's here for. So I want to finish up our meeting today with Brandy, because I think we're kind of getting into that whole mastermind session where we're talking. Patrick, I know it's not jump off a cliff, it's jump off a lake. Oh my goodness, my husband is such a micromanager. Listen, I'm a Nigerian. I always get these things mixed up. But Brandy is going to take us home. Brandy, you know what? I'm not even going to go through the details. I'm just going to open up the floor for you and just kind of talk about your team and what you guys are doing right now to kill it in today's environment.
Okay, well, you know what? I came on here to talk to y'all about who moved my cheese.
Yeah, that.
But so I think that it's important to understand that everybody has to go through this change, right? So our team, our cheese got moved as well. So we were doing everything one way, and then all of a sudden we had to realize that we had to adapt and overcome. And how many of y'all have read that book, Who Moved My Cheese? So you kind of understand what he was saying about, if you do not change, you will go extinct. And there were a lot of agents, I think, that they kind of looked at this as an excuse not to be productive, or this is their kind of staycation or stay at home. And our team kind of looked at it as, okay, what do we need to do differently so that when this all lifts, we are going to take off and move forward. So I'm going to say we have been super busy and we adapted as we should. And I don't feel like much changed, but our mindset changed because we didn't allow it to hold us down and we didn't use it as an excuse. We looked at it and we took that and we ran with opportunities. So who knows the definition of insanity?
Doing the same thing over and over again.
Doing the same thing over and over again and expecting results. A different outcome.
Yeah, exactly.
So one thing I learned about real estate real quick, and it's funny because I'm a routine person. I'm highly habitual. When I was in the Army, and I don't know if Houston can relate to this or not, but you all get up at the same time. You all dress the same. You go to your PT and you all run your 2 miles and you do your sit-ups and your push-ups, and then you go and you do whatever your job is, right? So you're kind of like robots. And then when you get out of the military, sometimes some of us, it's very hard for us to adapt because it's completely different. Well, real estate doesn't, we kind of approach it with routine, but there is never one day that is ever the same in real estate. There is never one transaction that is ever the same in real estate. And if you're not changing and you're not flexible, then you will become extinct. You will not succeed in this business. And there are days that I lay down on the ground in the fetal position, or I sit in the Starbucks parking lot and I eat cookies that have 500 calories in them. Or I call Melinda and I'm getting froyo on the side of the road because I have to get it out because there's too much change and it's so overwhelming. But it is safer. This is a quote from the Who Stole My Cheese or Who Moved My Cheese. It is safer to search in the maze than to remain in a cheeseless situation. So if you're not adapting and you're not going out there and working your business and looking at different opportunities in different directions, you're going to die on the vine. Mm-hmm. Jamila, what is the statistic of how many people fail their first year of real estate? I'm sure there's.
Gosh. I think it's close right now. It's a little over 80%.
Well, and I think that I'd be curious to see who's still in business after this quarantine is over, because like I said, there are agents that just took this as like, this is an excuse not to do business. And I think, the Bliss team right now, I think we have 7 closings on the books for May. Very exciting. We have, I think, 4 listings coming up. All of us have some buyers in the works. I mean, we have really adapted and figured out what we could do differently, and we didn't slow down. And Sometimes it was hard. I'll tell you that, because I kind of wanted to lay down and take a nap. But Robert had to jump up this morning and run down to a Galveston listing and put my sign up and make sure the door would unlock. I don't know, weird stuff happens. But, if you're not getting the results that you want because you've always done what you've always done, then maybe you need to look at what you could do differently. Another quote he said was, see what you're doing wrong, laugh at it, change it, and do better. Change and do better. And then the biggest thing that stops us from change is fear. And it says, basically when you stop being afraid, you'll feel better. And if you will allow the change happens when the pain of holding on becomes greater than the fear of letting go. So there are things that I was like, I've always done it this way, but I'm not really seeing the results now because our environment has shifted. So I have to shift my mindset, or I have to do something a little different. And we're seeing good results by being fluid. Do I like being fluid? No. But it's working, and I think that also as realtors, I think it's funny because we are the catalyst for change in other people's lives. Do you know what I'm saying? Like, we are their biggest change. We help them make the largest financial decisions of their lives. We are the ones that initiate the purchase or the sale of a home and guide them in that path. And then we are kind of the ones that divert the roadblocks. But we are creating change in other people's lives. And so we're forcing them to be fluid. And have you ever had a client that was so rigid? I mean, it's like talking to a rock and making them understand the situation. You have to adapt to the situation and then force them to adapt to the situation. So we are the catalyst for change. And then if we're resistant to it, again, we die on the vine. So I just, I read the book and I felt a little motivated, but I still cried in the Starbucks parking lot and ate cookies. Because not one transaction is the same, and not one day is is the same. Every day we wake up unemployed, and it's up to us to go out and get our job if we want a paycheck, or it's up to us if we're going to sit there and allow change and fear to hold us down. It's your choice. So I'm asking you today to embrace the change. And then it said, yesterday is gone. It's time to find new cheese.
That's right.
That's all I got.
Thank you.
Go find that cheese.
Brandy, that was so inspirational. Thank you so much. I hope you guys received that, because I did. That was awesome. So we have about 10 minutes just to kind of open up for discussions. If you have, you guys can unmute yourselves. Ask questions to Brandy, Kirby, Angelo, Rob, or just want to bring up a topic that we can kind of chat about for the next few minutes. This is open discussion time.
Well, Brandy, I felt like I was listening to a we're going home post-deployment speech from my battalion commander there for a second. I'm ready to go back to war. I don't want to go home.
You are at war. What are you talking about? We got some hornets coming our way.
Love it. Love it. Love it. Love it. Love it. Anyone else? That made me call on y'all, because I will.
Well, yeah, I can go back to what you were saying earlier, Jamila. If anyone has any questions later on, needs help, I know you're talking about helping the team with building their real estate portfolio. I mean, we're, a huge advocate, proponent, cash flow is king. And so we've helped a lot of our investors scale their portfolio. We deal with everybody from people just starting, or people that one of my largest client has 17,000 REO in his portfolio. So we can help anybody with that. So if you guys are trying to get into the fix and flip business, I've met with some of your agents actually, Jamila, on that topic, and discuss with them strategies on how to help them, because that's the biggest thing, is understanding the funding aspect, the rehab aspect, and getting the right crew. Rob is also an active investor, and he's done a lot of deals, and with the fix and flips, and he's done very, very well. A thing that's also really hot right now as well is not just fix and flip, but build to rent. Or, we talked about Airbnb. Some of my Airbnb clients are actually doing far better with those in long-term rental. So if you want more information on Airbnb or how to get involved in it, or fix and flip or how to become a passive investor with real estate. That's really what we do a lot of with our team.
Speaking of Airbnb, you guys may not know this, but it's a very, very interesting stat. The average income for an Airbnb in Houston is $2,600 a month. A unit. That's the average income. And so the average income per day is about $234 in Galveston. So it's a pretty, I started looking at those stats and I was going, this is not bad.
And I thought about that because and why I got into it. I have a house in Boulevard, and I was thinking about that. I started doing Airbnb with it, and I can charge $600 a night for it. Mm-hmm. But the person I was leasing it out to before, I was only charging them $5,000 a month.
Right.
And so I'm tripling my money, on Airbnb. Technically, I don't lease it out for all 30 days, but on average, 20 days of the month I can lease it out. I've always, the last 2 years, net on net, I've been able to double my money with Airbnb versus a long-term rental. So it makes a lot of sense, if you have the right property, so that's a huge thing right now, is Airbnb. And then there's another thing called Airbnb arbitrage, where you actually don't even have to own the house. And so, because you guys have contacts with all these sellers, and they may be having a hard time, unloading their property. So you can actually, there's a whole bunch of strategies out there that have multiple flows of income. So.
Awesome. Well, I want to thank you, Angelo and Rob and Brandy. You were amazing. I really appreciate you being such an amazing leader. That was awesome. I love that book, and you tied everything so perfectly to it. This was a great meeting, you guys. Obviously, next week we're canceled because we have our sales meeting, but we're going to keep this going even after we go back to the office full time, because I just think that there's so much that we can learn within this hour. I think it encompasses even more than a few weeks of training. I've learned a lot today. So, y'all have an amazing, amazing day. I'm about to jump on this 11 o'clock. I told somebody I was back to back today, but y'all have a good one. It's good to see everybody. Thank you again.
We'll see you soon.
And then we recorded it, so I'll post it on our page, okay?
Awesome.
All right, y'all take care.
Thanks for having us. Bye-bye.
Thank you. Bye-bye.